Capital gains tax. Exploring tax impacts on investments and properties. Agenda. Introduction to capital gains tax. Types of capital gains. Calculation of capital gains tax. Exemptions and reductions. Implications and strategies. Capital gains tax around the world. Definition of capital gains tax. What is capital gains tax? Capital gains tax is a tax imposed on the profit made from selling an asset, such as stocks or property. Assets subject to tax. This tax applies to various assets, including stocks, bonds, and real estate, affecting investors and property owners. Tax calculation. The tax is calculated based on the difference between the asset's purchase price and its selling price. History and evolution of capital gains tax. Initial absence of tax. In the early stages, many countries did not have a capital gains tax, leading to unregulated investment gains. Recognition of revenue need. As economies grew, governments began to recognize the necessity of capital gains tax for generating revenue. Introduction of capital gains tax. Eventually, many nations implemented capital gains tax systems to manage economic growth and investment profits. Importance and purpose of the tax. Government revenue generation. Capital gains tax is an important source of revenue for governments, funding public services and infrastructure. Promoting tax equity. The tax promotes fairness in the taxation system by ensuring that those who profit from asset sales contribute appropriately. Contribution to public finances. By taxing capital gains, individuals help support essential public services that benefits the community as a whole. Short-term versus long-term capital gains. Definition of capital gains. Short-term capital gains are profits from assets held for a year or less. Long-term capital gains arise from assets held for over a year. Tax rates differences. Different tax rates apply to short-term and long-term capital gains. Long-term gains are generally taxed at a lower rate. Investment strategies. Understanding the difference between short-term and long-term capital gains can influence investment strategies and tax planning. Realized versus unrealized gains. Understanding realized gains. Realized gains are profits made when an asset is sold, impacting your financial situation and taxes. Understanding unrealized gains. Unrealized gains are increases in asset value that remain unsold, representing potential profit. Capital gains tax implications. Only realized gains are subject to capital gains tax, influencing investment strategies. Assets subject to capital gains tax. Stocks. Stocks are considered investments that can generate capital gains when sold for more than their purchase price. Real estate. Real estate properties can appreciate in value, leading to capital gains when sold, making them subject to this tax. Collectibles. Collectibles such as art, antiques, and rare items can also incur capital gains tax when sold for more than their original price. Determining the cost basis of assets. Understanding cost basis. Cost basis is the original value of an asset, crucial for calculating capital gains effectively. Components of cost basis. The cost basis includes the purchase price and associated costs like improvements and commissions. Importance for capital gains. Understanding the cost basis is essential for accurately determining capital gains during asset sales. Methods of calculating gains. Specific identification method. This method allows investors to identify specific shares or units sold, impacting the calculation of capital gains. FIFO method. The FIFO method assumes that the first units purchased are the first ones sold, affecting the taxable gains. Tax implications. Different methods of calculating gains can lead to varying taxable amounts, impacting overall investment strategy. Tax rates and brackets. Capital gains tax overview. Capital gains tax is applied to profits from the sale of assets and varies based on income levels. Income level impact. Tax rates differ according to the taxpayer's income level, affecting how much tax is owed. Effective tax planning. Understanding tax brackets is crucial for effective tax planning and minimizing overall tax liabilities. Primary residence exemption. Understanding the exemption. The primary residence exemption helps homeowners reduce taxable capital gains when selling their main home. Criteria for exemption. Homeowners must meet specific criteria to qualify for the primary residence exemption on capital gains. Investment exemptions and deductions. Retirement accounts benefits. Investing through retirement accounts can provide tax exemptions and deductions, enhancing long term savings potential. Section 1031 Exchanges. Section 1031 exchanges allow investors to defer capital gains taxes on the sale of an investment property by reinvesting in another property. Capital gains tax deferral. Understanding exemptions and deductions can help investors manage capital gains taxes effectively and maximize returns. Tax loss harvesting strategies. Understanding tax loss harvesting. Tax loss harvesting involves selling investments at a loss to balance out capital gains. This can significantly lower tax liabilities. Benefits of the strategy. Implementing tax loss harvesting can lead to reduced overall tax liabilities for investors, optimizing their investment returns. Timing and considerations. Investors should consider timing and market conditions when implementing tax loss harvesting to maximize its effectiveness. Impact on investment decisions. Capital gains tax overview. Capital gains tax affects how investors approach buying and selling assets, influencing their financial decisions. Investment strategy implications. Investors must consider tax liabilities in their investment strategies, which can shift how they allocate funds. Strategic asset disposal. Impact of timing. Timing of asset sales significantly influences capital gains tax liabilities, affecting overall investment returns. Market conditions. Understanding current market conditions is crucial for maximizing asset value during disposal, leading to better returns. Holding period considerations. The length of time assets are held can affect tax rates and should be factored into disposal strategies. Planning for tax efficiency. Minimizing capital gains tax. Strategically minimizing capital gains tax is crucial for improving overall investment returns and achieving financial goals. Tax efficient funds. Utilizing tax efficient funds can help investors reduce tax liabilities while maintaining a strong investment performance. Tax advantaged accounts. Using tax advantaged accounts such as IRAs or 401ks can significantly enhance after tax returns on investments. Comparison of tax systems in different countries, varying capital gains tax rates. Countries adopt different capital gains tax rates, influencing investment returns and strategies for international investors. Tax exemptions and benefits. Some countries offer exemptions or lower rates for capital gains tax, which can enhance investment attractiveness. Investment strategies. Understanding different tax systems aids international investors in developing effective investment strategies based on tax policies. International tax treaties and implications. Impact on capital gains tax. International tax treaties can significantly influence capital gains tax liabilities for cross border investments, affecting overall investment returns. Navigating tax obligations. Understanding these treaties is crucial for investors to effectively manage and navigate their tax obligations in different jurisdictions. Future trends in global taxation. Evolving tax policies. Tax policies are adapting to changes in global economies, affecting businesses and individuals alike. Impact on capital gains tax. Emerging trends in taxation may lead to significant changes in capital gains tax regulations in the near future. Global cooperation. Increased cooperation among countries is essential to streamline taxation processes and address tax evasion. Conclusion. Importance of capital gains tax. Capital gains tax plays a crucial role in the financial landscape and impacts individual financial planning significantly. Understanding concepts. A clear understanding of capital gains tax concepts is necessary for making informed financial decisions. Implications and strategies. Recognizing the implications of capital gains tax allows individuals to develop effective strategies for tax optimization. Thank you.